Let's talk about 0 days to expiration options, ZDTE. It's easier for me just to say it out. Mark, real quickly, for anybody who doesn't know that's out in the crowd, can you give them a 30-second introduction explanation on what a 0DTE is?
Yeah, these are options primarily on the S&P. They expire into cash, so they disappear at the end of the day. You never have to worry about delivery. That's part of the reason why people like them so much. There's no stock at the end of the day on them. Two, because they expire at the end of the day, if the market is making a wild move that day, you can go right into the market and hedge your positions for the move that day. We've seen that the correlation from day to day is not there the way it has been traditionally, and 0DT allows us to trade that. So these are options on the S&P 500 that have been listed for several weeks, but expire the day that you trade them. So there are options that when the bell rings in 17 minutes will expire at exactly 4 p.m. Eastern time, and they expire into cash, which means if you buy an option for $5 at let's say a 40.50 call on the S&P, and the S&P goes to 40.75, when you wake up tomorrow, there will be $20 a contract in your account or $2,000. You don't have to worry about the stock. That's what makes them attractive.
Great. Why has everybody been talking about it? And it is everybody now. CNBC, Bloomberg was a little earlier. Zero Hedge, everybody. Why is it the hot topic of the day?
Ooh, you want me to take this or Garrett or both? Or
no, I want. Well, Elizabeth wrote you, so you.
All right. Well, I mean, I'm happy to talk about it, but I think Garrett's got some insight here too. One, it allows us to really on a highly levered basis. Yeah, it allows us on a highly levered basis at a relatively low cost to play these wild market swings on a consistent basis. And I mean 4 out of 5 days in the trading week, the top 20 options traded in the S&P are 0DTE. Typically, on the days when it's not, you might see 18 of the top 20 options that are 0DTE. In the top 40, you might see 3 contracts that are not 0DTE. Why? Because they truly allow us to take advantage of these market swings, and there is a huge amount of premium selling going on. Traders picking up dimes and quarters in front of a freight train, but that train is a lot less scary when you only have to wait it out for 5 or 6 hours. That's why we've seen a giant amount of premium selling in 0DTE. Now, what that means, though, is the market makers now have all of this gamma, these what my friend Mark Longo likes to call gamma bombs, where you get a really concentrated strike. We go down to that strike, the market makers have a ton of futures to buy, and the market pops. And it's almost a self-fulfilling prophecy. That's why the Baldwin bands have been working so well. These premium sellers are actually using those Baldwin bands to, I think, set where they're selling premium.
Well, let's flip that over now to Garrett. Garrett, you're watching with intraday momentum some of those same bands. What have you noticed in terms of the change of the dynamics of the market over the last, let's call it, month or so?
I mean, to be honest with you, I'm not necessarily convinced that the zero date is really the key issue as far as 2 other major elements within the market. One is liquidity, because if we go back and we look at what happened in October when the UK was on the brink, and we've dramatically expanded financial conditions since then. Look, we're right back where we were with the 1 year bond up at 5%. The bonds continue to moving higher, and this idea that there's only a specific amount of liquidity in the system. The Fed's $1 trillion reduction that's supposed to happen this year was already matched in terms of an increase by the Bank of Japan and the People's Bank of China. So look, capital's there, and it's helping to provide some support in this market. And I think that that's kind of where the bottom was in October. There's a lot of questions now about whether or not liquidity will dry up on the backside of this year. The other thing, though, is that the support levels are critical. And if you look at what happened 2 days ago, or 2-3 trading days ago with Bostic speaking, we were right at the 200-day moving average, the 39.40 level. Right. And that has been, effectively shown us going back to, these negative periods of momentum. That's where the buy to the dip crowd just kind of peters out. That's where the 0-day crowd kind of peters out. And we do see these kind of moves that move lower. So it's hard to make an argument that, 0 date is necessarily the challenge, the problem, considering that we had some serious negative momentum events that transpired back in April, which coincided with kind of this explosion in 0 date. And then we had the big sell-offs in August and the big negative momentum move in September and the negative momentum move in December 12th. And one of the other things that I think is critical, and a lot of people have just not answered this question for me, so I'm going to throw it to Andrew because you're the only person I haven't asked on this panel, is the last month and a half while the market was selling off, we had no insight in what the hedge funds were doing, largely on the back of the fact that the CFTC was hacked and Ion Group was hacked and the CFTC data was not provided. We have had very little insight into the futures markets and what hedge funds have been doing, 70 to 90% of volume. And that's why I think we did not have a pronounced sell-off that broke under that key resistance level. And if we would have had that data and we would have seen the amount of money that flowed out in February, which is very apparent in our momentum readings, I think we would have seen a pullback into that 3,600 to 3,700 level. But without that transparency, you didn't have retail investors panic the way that they previously had when funds dumped like they did back in June of last year and they did in September of last year. So I want to get your sense on what's happening with 0 date, but also just your general view around transparency in the market with data and the CFTC.
Take it, Ajo.
Wow. Data. Well,
I'm going to call him Ajo, like a J-Lo. Ajo.
AG. I think 0DTE, I think there's two different things, right? So VIX is mostly an institutional product. So whatever retail was in VIX, I think is migrating to the 0DTE. So I think they're two different. I think they're two different groups. So institutional is still going to trade VIX. They could trade the 0DTE if they need to. But I don't think the one is really affecting the other very much. Only as much as, let's say, forward vol jumps in the short term, and that might move VIX a little bit. But I think those are basically two different trading classes right there of people. As far as funds go, I don't look at that data. What I did see is we just haven't seen the spike in vol. So, when you want to make new lows or the market's worried about new lows, VIX will spike. And I know Mark talks about that a lot, but if VIX isn't spiking, there isn't that demand for that, that far out of the money option. So the only thing I could say is we've had really no VIX spike. We can't even get over 23 or 24. So I don't think the funds are worried about the downside because they're just not buying it. And you would see that worry would show up in VIX, higher numbers, buying more SPX puts and stuff like that. But farther out on the curve, not so much on the 0DTE.
Let me throw something out here real quickly, and we can bring Shaw in for this as well because Shaw's been around the block a couple times. Back when I got into the business in 1998, there were like 452 different companies that traded options, the regular quarterly options, right? You had your expirations that were set. As you added to that list, you could tell a difference in how the underlying traded once they started trading options, and especially as you gravitated towards expiration. And now we look at quad witching, we look at triple witching as these big expiration events. Does something similar happen where you mute the trading activity the price activity of the underlying as you add more of these 0 day or 1 day or 2 day to expiration options, and you basically get an effect of the tail wagging the dog? Shaw, you've been around to see these come in, and anybody else who's got a comment, what do you think?
No, we're seeing it already. We're seeing it specifically in the VIX. The reason the VIX is so muted is because everybody is going to 48 hour, whatever it is, DTE options, and the average of, I think it's 27 to 32 or 33 days, but really the VIX looks 30 days out based on that average of puts and calls that we use to calculate the VIX. there's too much premium out there. So if you're trying to hedge, you don't need to go out and spend that premium by buying VIX calls, for example. You want to buy something, you want to hedge, you're buying 0 DTE options, you're buying puts on SPX. You're going out for 24 hours, 48 hours. And that's why the VIX is so muted. So it's already impacting the market. That's impacting these risk parity funds and how they look at the VIX in terms of volatility and how they allocate capital. So this trend is it's about Wall Street product, it's about the exchanges product, about volume, about fees, and this is I think we're going to see another Volmageddon out of this. Folks, retail selling puts. That's a problem. You're selling premium, for example. It's not going to take much, 3 or 4 standard deviation move to wipe a lot of people out. And the reason that we're seeing, a couple of Thursdays ago, we saw a record amount of volume in call options, 0 and 48-hour DTE call options. That's fear of a melt-up. So this is what we're seeing. It's all coming down to very short-term trading because the premium, if you're buying, is pretty cheap. If you're selling, it's free money until it isn't.
All right, one last question. We'll go around the horn. Everybody give a yes or no. Mark mentioned gamma bombs. I love that term too. Yeah. And if we get a little more greedy, if these traders of these short-term options get greedier, maybe they start writing premium that's 2 days out, 3 days out, because why? More money. Does that create a gamma bomb that we at some point worry? And remember, gamma bombs can go up or down, right? Volatility is not directional. What's everybody think?
We're going to see it. We're going to have it. And the bomb is, it could be a melt up, there could be a meltdown, but there's going to be some trigger at some point. I fear a meltdown on account of the fact that it's going to hit margin. We're going to get margin calls, and then that could tumble further down. More put buying, 0 DTE. Then you got the gamma, the hedgers, they're shorting futures, the market makers. That could be nasty. That's what I worry about.
Andrew.
Yeah, I mean, historically, right, there's always, when you launch a new product, remember before, like in 2018, the Volmageddon, everybody said, 2017, you short the vol and it's instant money, right? You can't possibly lose. And everybody jumps in and then it all blows up. So it's likely that this is going to happen with this product, and then everybody gets a little sense of how to trade it, because right now it's pretty sexy and they want to get in. So usually there will be one generation that gets their nose punched in, and other generations will learn from that. So it is a potential for retail to get hurt, I think.
This is so Sean, Andrew are dead right. So I had conversations with people who have notoriously blown themselves up selling pennies in front, or picking up pennies in front of steamrollers. And now I'm hearing people say, well, I can trade iron butterflies all day and I can make 2 to 3%. And I'm saying, well, how much can you lose? Well, we can lose 50%, but it's winning, 9 out of 10 times. And I'm sitting here saying, are you listening to yourself? Are you listening to yourself? Because this is not just going to be an up-only strategy. And people do this all the time. They think that these are proven. Look, we've watched really great hedge fund managers absolutely implode because they don't see what is coming down the pipeline. And at some point, you're going to get, maybe it's a 50 basis point hike. Maybe it's some sort of geopolitical event that transpires. But if you look back at January 8th of last year and you see how far and dramatically the market fell because it was the largest hedge fund sell-off in 15 years, and you get another one of those days, there's going to be a lot of people who are going to be nervous to be playing this zero-day game anymore. You guys can play it until it breaks, but I'm already standing right next to the door, and the moment that the alarm goes off, I'm gone. Have fun.